And this is a video I'm going to prepare to cover basics about accounting. And this video is for someone who wants to increase their knowledge about accounting, or someone who has already done their accounting years ago and forgot about it, or maybe a fresh student or new student who wants to learn about accounting. So this will be a good video to look for, maybe 5 to 7 minutes. So to first thing first is like what's the main important equation in accounting is assets is equal to liability plus owner's equity. So that's a basic principle of accounting. So what we are saying is all the assets should be equal to your liabilities and your own contribution. Now I can take this with an example for you guys. I prepared. So let's take an example of property. So say for example you buy a house, and house is for 100,000. So what you will do, you'll have to pay 100,000 to buy that house. So cost of house is 100,000. So maybe you have okay, let me change it. Okay, so maybe you have some amount with you to buy that house, so maybe 10%. So in that case, what you will do, you will contribute 10,000 towards to purchase of that house as a down payment, and that's your own contribution. And the balance amount you can take a loan from the bank, so that is 90,000. So in this case, asset is 100,000, and this is loan from the bank, which is known as liability, and this is owner's contribution, that is on your equity portion. So here it is, we proved the equation assets is equals to liability plus owner's equity. So that's the basic principle. Now let's think from the accounting point of view. What is debit? What is credit? So for that, we can move to the next slide, which talks about what is debit and what is credit. So first, I will cover two important reports. Basically, first one is balance sheet, which is known as a permanent account, and second report, which is important, is income statement, which is known as temporary account. So why it is permanent and temporary? So balances are permanent because it doesn't change when you close the year. So and the amount gets added to it at the end of the year. Whereas in income statement, you prepare an income statement for particular period. So usually it is for the year or for the month, and then you move on those balances to balance sheet. So that's why income statement is temporary and balance sheet is permanent. So coming back to the balance sheet accounts, one is assets, second one is liability, and third one we talked about is owner's equity. So that is also known as capital account. So what is a normal balance for the assets account? It is known as debit balance, and for liability account it is known as credit balance, and again capital account is known as credit balance. So which we saw, that is 100,000, this is 90,000, and this is your 10,000. So in layman's language, what is debit? Debit is like if you want to add something, that is debit for assets. So if you have an asset and you want to add something in that, you will add to a debit side. So that's exactly opposite for the liability side. If you have a liability, in this case a bank loan, and you want to add something or maybe take more loan, you will go and add to a credit side. So you added account in the credit side. And same logic applies to a capital account, that is owner's equity account. If you want to add something to that account, you will go and credit to that account. So in this case, let's take an example, going back to the Excel example. So when I'm saying debit, so this is an asset account because this is in a house. So we can cover in the next video or maybe in future sessions what is assets and liability. For this video sake, we can say the assets which has a future benefit, the property or something which has a future benefit is known as asset. So 100,000 is asset, that's why we debit it here. And owner's equity is 10,000. That's why credited here. So DR stands for debit and CR stands for credit. And bank loan of 90,000 we credited here. So this is in a journal entry form. Let's look how it looks in a tabular form. So okay, so this is a balance sheet and asset side on the left hand side, and this is a liability. It's usually in right hand side. So this is in financial world or business world. This is how the statement made for the accountant. If you go to accountant, he will prepare a balance sheet statement for you. It will look like same like this. So assets on the left hand side and liability on the right hand side. So here you can see the house, which is 100,000, which is on debit. So we want to add it. So that's an asset side, which is here, and owner's equity, which is a credit side. So that's 10,000 here, and bank loan, which is credit side, that is 90,000 here. So this proves our the previous logic of saying assets is equals to liability. So you can see assets of 100,000 matches with total liability plus equity. So that's that. So basic question. So once I know, I have thinking like usually when it comes to salary or something is getting credited to your account, it says salary is credited, whereas I'm saying it's a debit for your asset. So it's quite confusing. So when I'm saying asset which can be used future benefit, so house is something I can use for the future benefit. So that is an asset. So cash, which is I'm receiving in my salary account, which I'll be using future benefit, right? So that is an asset for me. But why we always say credit to you, salary has been credited, even if the money as received by you. So basically, it's a credit not for you; it's for liability on the bank side. So whatever records or accounting entries are happening in the bank side. So for bank, the funds which is credited to your account is a liability. That's why they say credited to your account, because it's a liability for them, because it's something, an obligation they have. You will ask that this is a 50,000 in my bank account, I need to withdraw it. So it's basically liability for them. That's why they will debit as a, so that's why they will show as a credit as opposed to debit. So I guess this helps to give a basic information about accounting, about assets and liability. And so we have, I think, another 4 minutes, so I can quickly cover about income statement. So as you remember, I said balance sheet is a permanent account, and income statement is a temporary account. So basically, what it means is like we will prepare balance sheet, account statement, income statement, monthly basis or yearly basis, and we will transfer those balances to balance sheet account. Thank you.